Good evening, students. So we were on the income from other sources class. I just want to check with you. Do you have any questions, any doubts in with regard to so far what we have done with respect to the general charge and the specific charges that we have discussed so far? If you have any questions, you can please ask me. Good evening, Amit. In case there are no further questions, I think we can just quickly proceed because we have to finish today the income from other sources. Okay, so what we are going to discuss today, students, is we are going to talk about the dividends. Then we are going to talk about the gift taxation. And then after we will be talking about the ULIPs and the LIPs, which is also concerning the CBDT circular around that point. So we are going to touch upon all these aspects, and then that will wind up your all the heads of income. So let's get quickly started. So first, about the dividend. So just write down. Good evening, Jenny. Dividends. Dividends are defined in the which section? Section 222. So let's go to section 222 of the Income Tax Act. And let's see how the dividends are defined therein. So let me take you to the Income Tax Act. Yes. So 222, dividend includes, this is an inclusive definition. Dividend includes, what all it includes?
Excuse me, ma'am.
Yeah.
Screen is not visible when you shift to act.
Okay, 1 second. Is it visible now?
Yes, ma'am.
Okay. So dividend includes any distribution by a company of the accumulated profits, whether capitalized or not, if such distribution entails the release by the company to its shareholders of all or any part of the assets of the company. So basically, the first segment, 222A, includes the distribution of the assets. So let's say, for example, instead of company giving me the cash, the company resorts to distribution of assets. It's a dividend in kind. So to the extent of the accumulated profits, this would be regarded as dividend. So these are the categories of the deemed dividend, 222A to now 222F, where a company, instead of directly giving the money to the shareholders, is trying to resort to different means in order to come out of the definition of the dividend. So therefore, this was a specific anti-avoidance regulation students put in place in order to curb any means of the distribution by the company, which is disguised as some other form of distribution, but is in fact the dividend. Are we getting this particular point? So, distribution of the assets is 222A. Then, what is 222B? Any distribution to the shareholder by a company of debentures, debenture stock, or deposit certificates in any form, whether with or without interest. And any distribution to the preference shareholders of the bonus share. to the extent to which the company possessed the accumulated profits, whether capitalized or not. So 222B is distribution of debentures to the shareholders. Are we clear? So this is point number B. Then we have distribution made to the shareholders of a company on its liquidation, to the extent to which the distribution is attributable to the accumulated profits of the company immediately before its liquidation, whether capitalized or not. Now, do you remember something over this point? This should directly strike something because this we have dealt in the past. What does it strike to you, students? Distribution on the liquidation. Yes.
Capital gain, it was section 46.
Yes, absolutely. So, if you guys remember, under 46, we have already done with this particular point, which is distribution on liquidation. So, to the extent of the accumulated profit, students, this would be regarded as the deemed dividend. Over and above the accumulated profits, this would be regarded as the capital gains, or will be taxable or will be chargeable under the head capital gain. Isn't it? So to the extent of the accumulated profit, this would be regarded as the deemed dividend. Over and above that, what will be the implications in the hands of the company which is issuing the dividend? Yes. What will be the implication? Yes, students, faster.
Ma'am, it is not taxed in the hands of company, and it will be taxed in the hands of the shareholders.
Yes, it will be taxed in the hands of shareholder. It will not be taxable in the hands of company. So if you remember under 46, in the hands of company, under 46(1), there was no taxation in the hands of the company. Whereas this will be getting taxed in the hands of the shareholder under section 46(2). And what was the taxation under 46(2)? How we used to tax under 46(2)? What was the computation? Yes. So if you see this, in the hands of the shareholder, there is deemed dividend, and under 46(2), the FVC will become the money received plus the FMV of the assets transferred as on the date of distribution minus the amount taxed under 222C. What was the period of holding? Period of holding was from the date of purchase, from the date of asset which is there with me, which is the shares basically, from the date of purchase of share till the date of commencement of the liquidation. And when I transfer the asset that I've got under liquidation, then in that particular case, I will get the FMV taxed under 46(2) as the cost of acquisition. And the period of holding will include the period of holding of asset which was with the company. Are we clear? So you have to link the provisions and then you don't have to isolate the provisions and then because then you will tend to make a mistake in the examination. Yes? Okay. So then what is 222D? Next one. Let us understand 222D. Any distribution to the shareholders by a company on the reduction of its capital to the extent to which the company possesses the accumulated profits which arose after the end of the previous year, whether such accumulated profits have been capitalized or not. So, distribution on the capital reduction. Are we clear? So, this is all of this is to the extent of accumulated profits, whether capitalized or not. Are we clear? So to the extent of my accumulated profits only, this will be regarded as distribution of dividend. Over and above accumulated profit, this will not be taxed as dividend. Are we clear? 222E. Any payment by a company not being a company in which the public are substantially interested. So if you see 222A to 222D was applicable to all the kind of company. Whereas 222E, it is saying any payment by a company not being a company in which the public are substantially interested. What do we mean by a company in which public are substantially interested?
Listed company in which the public is substantially interested, ma'am.
Listed company is a company in which the public is substantially interested. Okay, you are saying. So what is a company in which the public is not substantially interested? Yes. What is the definition of the company?
Closely held company.
Closely held company. So that is the, normal name that we give it to it. So a company in which public is not substantially interested is called as closely held company. That's a, just nomenclature that we use. But what do we mean by that? Yes, any idea to anyone?
Private limited companies, ma'am.
Private limited companies, yes, that's one example. Yes, private limited company. So let's look at what do we mean by company in which the public are substantially interested. That is defined under 218. So 218 says a company in which the public are substantially interested. A company is said to be a company in which the public are substantially interested if it is owned by the government or RBI or in which not less than 40% of the shares are held by government or RBI or a corporation owned by that bank. If it is a company which is registered under Section 25 of Companies Act, Section 25, what is it? Of 1956, not of 2013. This was the non-profit organization, which is now under Section, under Companies Act 2013, you have Section 8 companies. Right? If it is a company having no share capital, and having regard to the considerations, it is declared by the CBDT that it is a company in which public are substantially interested. mutual benefit finance company, or which is called as a nidhi company or a mutual benefit society. A company wherein the shares carrying not less than 50% of voting power are held by one or more cooperative societies. If it is a company which is not a private company, so meaning private company will be number one in which the public is not substantially interested. Because this is what we are talking about, a company in which public is substantially interested. Now, a company which is not a private company, meaning it will be the public company, right? It will be a public company. And the conditions either in item A or B are fulfilled. What are A and B? Shares in the company were, as on the last year of the relevant previous year, listed in a recognized stock exchange in India. So a listed company on a recognized stock exchange. Remember this. They are not saying a listed company on an unrecognized stock exchange. There are many stock exchanges which are not yet recognized. So listed company is a company in which public is substantially interested. Not an unlisted company. Unlisted company, whether that is also a company in which public is substantially interested. Let's see point B. Shares in the company carrying not less than 50% of the voting power have been allotted or beneficially held by the government, corporation established by central, state or provisional act, a company to which this clause applies, or any subsidiary company of such company if the whole of the share capital of such subsidiary company has been held by the parent company. Which means what? An unlisted public company, if only it is a subsidiary of a listed company, then only it will be a company in which the public is substantially interested. Otherwise, that will also become a company in which public is not substantially interested. So if it is not a wholly owned subsidiary of the listed company, then in that case, it will be a company in which public is not substantially interested. Are we clear? So 222E. applies to a closely held company, which is private limited company or unlisted company in which is not a subsidiary of the listed company, or which is not wholly owned subsidiary. Of the listed company. Are we clear? So let's read now 222F. What does it say? Sorry, 222E. What does it say? Any payment by a closely held company. Of what? Of any sum, whether as representing a part of assets of the company or otherwise, by way of advance or loan to a shareholder. So payment by a closely held company of loan or advance to a shareholder. So this is giving loan or advances to the shareholder. Now, whether loan or advances to every kind of shareholder is something which is covered over here. Answer is no. This is covering, let's read, what does it say? Which kind of shareholder it is talking about? being a person who is the beneficial owner of the shares, holding not less than 10% of the voting power. So, being a person who is the beneficial owner of the shares, not being shares entitled to a fixed rate of dividend, whether with or without a right to participate in profits, meaning it should be an equity shareholder and not the preference shareholder, because preference shares have a fixed rate of dividend. So it's saying any loan or advance to an equity shareholder who is holding not less than 10% of the voting power. So number one, loan or advance to the equity shareholder holding greater than equal to 10% of the voting power, or to any concern in which such shareholder is a member or a partner and in which he has a substantial interest. So, if the company is not giving loan directly to that equity shareholder, but it is giving the loan to any concern in which such shareholder is a member or a partner and he has a substantial interest. So, any concern in which the shareholder, or we can write equity shareholder holding greater than equal to 10% of the voting power is a member of that particular is a member or partner of that concern plus has a substantial interest in the concern. Now, what do we understand by the substantial interest in the concern? What do we understand by a substantial interest in the concern? So, explanation 3 talks about what do we mean by substantial interest. A person shall be deemed to have a substantial interest in a concern other than a company if he is at any time during the previous year beneficially entitled to not less than 20% of the income of such concern. So, has greater than equal to 20% of interest, has greater than equal to 20% of the interest in income, or you can just write like this. Is entitled to greater than equal to 20% of the income of the concern. Concern would mean any kind of HUF, firm, AOP, BOI, company, whatever. Are we clear? So if I'm not giving loan directly to a shareholder, but to any concern in which such shareholder is a member or a partner and has a substantial interest. So let's take an example for this. So let's say, for example, A Limited is giving the loan to the shareholder. This will be the first scenario. This is also deemed dividend. Now this shareholder is, let's say, having the shares, let's say, of 15%. This is deemed dividend under section 222E. Example B would be A Limited is giving the loan to ABC LLP. Now, in the A Limited, Mr. A has 15% holding. And in the ABC LLP, Mr. A has profit sharing ratio of, let's say, 1:1:1. Right? Which is 33%, basically. Right? So in that particular case, this will also be deemed dividend under section 222. Then the third scenario, or any payment by any such company on behalf of or for the individual benefit of any such shareholder to the extent to which the company possesses the accumulated profits. So, third scenario is the payment for the benefit of the shareholder. For example, let's say travel fees for personal benefit or travel charges for the personal benefit. This is again a deemed dividend. Are we clear? So to the extent of the accumulated profits, this will be regarded as the deemed dividend. Yes or no? Any doubts? Any questions so far? Yes. So this is to the extent of the accumulated profits. Yes. So accumulated profits means what? Accumulated profit will be all the distributable profit of the company up to the date of distribution or up till the date of liquidation in case of 222C. Are we clear? Yes or no? In the case of the amalgamated company, the accumulated profits will be including the profits of the amalgamating company. Fine? So just write down over here to the extent of the accumulated profits up to the date of distribution or liquidation or the payment. This is only for 222C. Okay. Now, in case of 222E, where I am paying any loan or advance. Now, in that case, it says the dividend shall exclude. So, if you see, 222 says, but dividend does not include. Dividend does not include any advance or loan made to the shareholder or the said concern by a company in the ordinary course of its business where the lending of the money is substantial part of the business of the company. Where a company is into the money lending business, and if it gives the loan to the shareholder or to any concern, then that will not be regarded as deemed. Are we clear? So here you can just write out excludes loan or advance given in the ordinary course of business, or where lending is substantial part of the business. Yes, so where the lending is a substantial part of the business of the company. In those cases, it will not be regarded as the deemed due. Now, usually there are many instances that it is possible that the loans are given or the advances are given, which are nothing but in the form of, let's say, trade advances. Yeah, I mean, it's, very general practice that sometimes the companies would, issue the dividends to the, would issue the advances to the shareholder. So whether in every case, this will be regarded as the deemed dividend. So in that case, there is a CBDT circular on this particular aspect. So CBDT has given the clarification regarding the trade advances not to be treated as deemed dividend. So where advances were made by a company, let's say to a sister concern, with respect to any work to be performed by the sister concern, that is normally trade advance. Or was where the advance is given by the company to the shareholder to, let's say, purchase the plant and machinery for the company. It is normal thing, right? Sometimes the company gives the advance to the shareholder to, let's say, purchase a computer, to purchase a plant and machinery. That's a trade advance. Where sometimes the deposits are given by the company to the sister concern so that they can, procure some order for the company. So any kind of advance which arises in the normal course of business activity, the CBDT has clarified that these would not be regarded as due. So you can write down here, trade advances arising in the normal course of business activity. Are we clear? Yes or no? Any questions so far? Any doubts? Are we clear about the deemed dividend applicability? Okay. So in these particular cases where the trade advances are given, that shall not be regarded as deemed dividend. Fine. Now, understand one particular stuff. There is new provision added under 222F. Now, what is 222F? Let us understand that. So, any payment by a company on the purchase of its own shares from a shareholder in accordance with the provisions of Section 68 of the Company Act 2013. So, here it doesn't use the word to the extent of accumulated profits. So, therefore, if you see, I have marked this particular line only till here. There is 222F. 22F, which is payment by the company to purchase its own shares. To purchase its own shares as per section 68 of the Companies Act. Students, do you recollect something on this particular point that we have already done?
Buyback of shares.
Yes. What was the provision for that?
Ma'am, exempt to the shareholders.
Exempt? No, that was on the liquidation. Yes. Go back to your notes. Yes, go back to your notes on the capital gain and tell me what was exactly the point. All of you. We have again done this.
Ma'am, in the buyback of shares, the consideration that the company will pay to the shareholder will consider as deemed dividend, and which is taxable in the hands of the shareholders, and it will come in the income from other sources, and the company cannot claim the as expenditure, but uh, uh,
Yes. Anybody else would like to attempt here? Yes.
When the these shares were got sold, it can consider it as it can claim the cost of acquisition as the amount.
Okay. So yes, under section 46A, if you remember,
Yes, ma'am.
we had talked about the buyback taxation in the hands of the shareholder. So there, if you remember, I had told you prior to which date are we talking about? Prior to the Finance Act 2024 amendment, right? So then there we used to have a buyback tax applicable under section 115QA. Right? There we had specifically the buyback tax applicable at the rate of 20%. Now, after the amendment which has taken place, that tax was abolished. So, in the hands of the earlier shareholders, the amount used to be exempt because there was buyback tax applicable in the hands of the company undertaking the buyback. See, pre-1/10/2024, buyback of shares by the domestic company, there used to be a buyback tax in the hands of the company under 115QA at the rate of 23.296%, which was consideration minus cost. And in the hands of the shareholder, it was exempt. Right? Whereas now, what they have done is, post 1st October 2024, they are now saying that the buyback of shares by a domestic company, there will not be any buyback tax. It will be regarded, the consideration which is paid by the company will now be taxable as a dividend in the hands of the shareholder. So earlier, prior to 1/10/2024, in the hands of domestic company, it used to be buyback tax. And in the hands of shareholder, it was exempt. Right? Now, this is taxable as dividend in the hands of shareholder under section 222F. And no expenditure will be allowed against that dividend. In the hands of other company, buyback of shares by any other company, it used to be taxable in the hands of shareholder under 46A. Buyback of shares by any other company. But by domestic company, there used to be 115QA buyback tax. By any other company, it used to be taxable in the hands of shareholder as capital gain under 46A. Now, what they have said that the cost of acquisition of those shares which are bought back will be claimed as a capital loss under section 46A, which will be allowed to be set off and carry forward only against the capital loss, capital gains. Short-term capital loss against short-term capital gain or long-term capital gain. Long-term capital loss only against long-term capital. Are we clear about this aspect? So under 222F, now you have this consideration paid on the buyback of shares. You can write down the cost will be allowed under section 46A as a capital loss which can be carried forward and set off against the capital gains. Okay. Yes or no? Are we clear about this particular point? Yes. There's one problem which is given in the module. Let me share that with you so that we are illustratively also on the same line. Yes. Is the screen visible to all of us?
Yes, ma'am.
Yes, it is. Okay. See, number of shares of A Limited bought in 2020 by Mr. B at 40 per share. 100 shares were bought. Total cost of acquisition 100 into 40, 4,000. Number of shares being bought in November 24 by A Limited. Now, this is post 1st October. If it was prior to 1st October, there was buyback tax under 115QA. So, you have to remember both. This is in November. So, therefore, 60 rupees per share, they have bought back the 20 shares. So, income taxable as deemed dividend under 222F will be 60 per share into 20 shares, which is 1,200. And the cost with respect to these 20 shares, which is 40 per share into 20 shares. This will be a long-term capital loss on the buyback as per 46A. Right? This is purchased in 2020 and the consideration is paid in 2024. So, therefore, the period of holding is more than 12 months. If it's a listed share, then in that particular case, this will be considered as a long-term capital loss, which can be set off only against the long-term capital gain. Are we getting that? Now, let's say he has sold the shares in December 25, the balance shares he has sold in December 25, let's say 50 shares at 70 per share. So, he is having a gain of 70 into 50, out of which he will be able to reduce the earlier long-term capital loss of this 40 into 50 shares. Are we clear? Yes or no? Any question, any doubt? Yes? Yes or no? So we'll be able to reduce the losses then. Okay? Any question, any doubt? Yes, faster. Is it clear? This is very, very, very important. Okay, perfect.
Clear,
Now,
ma'am.
yes. Okay. So let's proceed then further. This completes your dividend taxation. Right? So 222A to 222F. Under 222A to 222E till the extent of the accumulated profit. And after that, in 222F, you don't have to see the accumulated profit. Now, when are the dividends chargeable to tax? In which year you will charge the income of dividend to tax? Whether in the year in which it is distributed, whether in the year in which it is paid, or whether in the year in which it is declared. So in which year you will charge the dividend to tax? Yes, students. Yes?
Ma'am, declared.
In the year in which it is declared? Okay.
Yes.
Then what about the dividend under 222E? Yes? Yes, students. So let's look at section 8 of the company. Let's look at the section 8 of the company to understand this. Now, section 8 talks about the taxation of the dividend. See. Dividend income. It says, for the purposes of the inclusion in the total income of an assessee, any dividend declared by a company or distributed or paid by it within the meaning of 222A, B, C, D, E shall be deemed to be, yes?
Ma'am, screen is not visible.
Okay, 1 second. Is it visible now?
Yes, ma'am.
Yeah. Shall be deemed to be the income of the previous year in which it is so declared, distributed or paid as the case may be. So whichever is earlier, whether declared, distributed or paid. In the case of 222A, we are declaring or we are distributing the assets. So in the year of distribution. In 222B, you are distributing the debentures or the bonus shares to the preference shareholders. 222B on distribution. 222C, distribution of assets on liquidation, again on distribution. 222D, distribution of on capital deduction, again on distribution. 222E, payment of loan or advance, so on the payment basis. Normal dividend in the year in which it is declared. Right? Any interim dividend shall be deemed to be the income of the previous year in which the amount of such dividend is unconditionally made available by the company to the member who is entitled to it. So you can just write it over here. taxability of the dividend in the year of you can just write section 8. Dividend in the previous year of declaration. 222A to 222D on the distribution. 222F on the payment. Interim dividend when unconditionally made available to the shareholders. Clear? So this completes our dividend taxation. Fine. Now, okay, one more point you can just write down over here for the accumulated profits. Accumulated profits of the amalgamated company shall include accumulated profits of the amalgamating company. Are we clear? So then here you can write dividend excludes what does dividend excludes? Dividend excludes any consideration which is paid on the demerger of the company. Right? When the demerger is happening, at that point in time, if any distribution of shares is made pursuant to a demerger by a resulting company to the shareholders of the demerged company, that is not dividend. So you can just write down distribution of the shares by the resulting company to the shareholders of the demerged company. That is not regarded as the dividend. Are we clear? Any question, any doubt? Yes? Fine? Okay.
Ma'am?
Yeah.
You have written in the dividend section normal dividend declaration 222A to D. It is on
declaration of distribution of assets. Yes.
And directly F and for E we will consider declaration.
Sorry, it's E, not F. For E, it will be payment of loan or advance. And for 222 F, it will be payment of consideration on the buyback. Clear?
Yes, sir.
Okay. Now, with respect to the deduction under section 57, there's a deduction which is available under section 57 with respect to the dividend income. Now, what is this deduction about? See, as I said, you have to interlink everything and then you have to study. It should not be the case that you are studying anything in isolation. So when you have the dividend income, so the interest on loan, the interest expenditure which is there, right? In the case of dividend, other than 222F, as I said, for 222F, you will not get any deduction, right? So in the case of dividends, other than that referred to in 222F, any reasonable sum paid by way of commission or remuneration to a banker or to any person for the purpose of realizing such dividend or interest on the behalf of the assessee. So basically, any expenditure that you pay as commission or maybe any remuneration to a banker to realize the dividend, that will be allowed as a deduction. Are we clear? Secondly, you will also be allowed not more than 20% of the dividend income as the interest expenditure. So under 57, if you read, it is given, provided that no deduction shall be allowed from the dividend income. Any deduction in respect of interest expense and such deduction shall not exceed 20% of the dividend income. Are we clear? So, no deduction shall be allowed from the dividend income other than the deduction on account of interest expense, which shall not exceed 20% of dividend income. So, you can just write here, against the dividend income. Commission and all you can claim. Secondly, interest expense up to 20% of the dividend income. This is dividend other than under section 222F, which is for buyback. Are we clear? Because against the buyback, there will not be any deduction which shall be allowed. You can just write it over here. No deduction of the expense. Are we clear? Fine. Now, one more important point, which is not in relation to this chapter, but I would like to discuss here because that will create again a linkage for you. Deduction under section ATL. What is section ATL? Let us understand. Deduction in respect of intercorporate dividend, where the gross total income of a domestic company, this is only allowed to a domestic company, if the gross total income includes income by way of dividend from any other domestic company or a foreign company or a business trust. So one domestic company receiving the dividend from foreign company, another domestic company, or any business trust. Right? In these cases, the deduction will be allowed to the domestic company if it also distributes the dividend during that year. So what it says is, there shall, in accordance with and subject to provision of this section, be allowed in computing the total income of such domestic company a deduction of an amount equal to so much of the amount of income by way of dividends received from such other domestic company or foreign company or business trust as does not exceed the amount of dividend distributed by it on or before the due date. What does due date means? Due date means the date 1 month prior to the date for furnishing the return of income. So, deduction of the amount of dividend which is distributed by it, right? Which is distributed by it, or dividend received by it, whichever is lower. So, deduction of the amount of dividend received by it or dividend distributed by it, whichever is lower. So this is to avoid the cascading effect of tax, because one company receives the dividend, it will be taxed, then again another company to which it will distribute, it will also be taxed. So in order to avoid the cascading effect on the intercorporate dividend, deduction under section 80M is allowed. So this is only for the intercorporate dividend, and it is available only to a domestic company, but this can receive dividend from any other foreign company or business trust or domestic company. Distributed by it before the due date. Now, what is the due date? 1 month prior to the return filing date. Now, students, a question to you. Whether this deduction is allowed, whether this deduction will be allowed when I will opt for the concessional tax regime under 115 BAA or 115 BAB. Yes.
Ma'am, please repeat the question.
The question is that can we get the deduction of ATM under 115 BAA or BAB, which is a concessional tax regime? Yes. You have already done in your basic concepts class the concessional tax regime. Kirti, yes, if the buyback will be in August 24, then the answer would be as per 115 QA and not as per 222F. You're right. Yes, students, faster. Yes, I'm not getting any answers. Have you not done 115 BAA BAB provision, whether ATM is allowed or not? I want to know the answers. Very simple question. whether it is allowed under 115 BAA or BAB regime or not. Yes, students, fast.
Yes, ma'am, allow.
It is allowed? Yes.
Yes.
So this is allowed under section, even when you claim the concessional tax rate of 22% or 15% under 115 BAA or BAB, this will be allowed. So allowed under section 115 BAA or 115 BAB concessional regime. See, all of us, if you look at, we are linking the provisions. If you read 115 BAA separately, you will not recollect about this. And then it is, very confusing during your exam time when you are already under so much pressure. You may think, koi deduction allowed nahi hota hai 115 BAA BAB mein. But when you read all of this together, you will be able to remember the students. See, if you look at your, study pattern, you will do ATM under chapter 6A deduction class. You will do in this buyback under capital gain. You will do income from other sources with 222A to 222F. And then 115 BAA you are studying separately. You will not be able to remember anything. You have to link and remember. Are we getting this point? This is how the study has to be done. So let me just give you the example for this, for ATM. Let's say there is a subsidiary company. This is distributing the dividend of, let's say, rupees 5 lakh to its holding company. Now this again company declares the dividend to the shareholder, let's say dividend of rupees 7 lakh. So this will get a deduction of rupees 5. If it has distributed the dividend on or before the due date, which is 1 month prior to the return filing date. Yes, are we clear about this provision? Yes or no? I need answers.
Yes, ma'am.
Yes?
Yes.
Yes. Okay. Perfect. Let's go further. Now let's move to section 56 to 10. What was 56 to 10? Last time we were discussing. I just made a mention about that.
Gift, ma'am.
Gift taxation. Okay, let's write down. Section 56 to 10. Now, let us try and understand what does 56 to 10 says. Okay. So, first is receipt of three type of things here we are covering under 56 to 10. Just write down here gift taxation. Number one. Let us read simultaneously from the Act. See, with this, you have now mastered the practice of reading Act also. Now you will be independently able to read it even in practical cases, right? So 56 to 10. What does it say? Where any person receives in any previous year from any person on or after 4/2017. A. Any sum of money without consideration, the aggregate value of which exceeds 50,000. So, sum of money greater than rupees 50,000. In that case, the whole of the aggregate value of such sum shall be taxable under section 56 to 10. So what are we trying to say? That when you receive more than 50,000 in cash, right? Any sum of money more than rupees 50,000. Then in that particular case, this will be taxable in the hands of whom? In whose hands it is going to be taxable? Yes. In whose hands this sum of money will get taxed?
To whom the person who received the gift.
Correct. This shall be taxable in the hands of the person who will receive the gift. So entire amount will be taxable. Entire receipt shall be taxable. This tax is in the hands of the recipient and not in the hands of the giver. So sum of money more than rupees 50,000 received without any consideration. What do we understand by received without any consideration? What do you mean by received without any consideration? Meaning you are not receiving for some amount of service that you have rendered. You are receiving without any consideration, without you giving any service, you providing any goods, without you doing anything for the other person. It is a gesture that he is showing to you. He is giving you the money free of cost. This is regarded as a benefit. And therefore, this is specifically charged to tax under 56(2)(10). See, this is a capital receipt. This is not a revenue receipt. Do you receive the money every day from everyone? Answer is no. This is not a revenue receipt. This is a capital receipt. And as I was telling you in the last class, a capital receipt will only be charged to tax when this is specifically provided for students. If this is not specifically provided for, this will not be taxed. A capital receipt is not always an income. It is an income if it is specifically brought or introduced in the definition of income. And this is one such example. Clear? Next is any immovable property. So what it says is where any person receives any immovable property. So number B is receipt of immovable property. A was receipt of sum of money. B is receipt of any immovable property. Number 1, without consideration. The stamp duty value of which exceeds rupees 50,000. So, if I receive without consideration and if the stamp duty value exceeds rupees 50,000. So in that particular case, the entire SDV would be taxable. So then the entire stamp duty value of such property will be taxable. Entire SDV would be taxable in the hands of recipient. And where I receive for inadequate consideration. For a consideration, the stamp duty value of such consideration as exceeds such consideration. So what do I mean by for inadequate consideration? So inadequate consideration means that where the stamp duty value of the property minus the consideration that I have paid is more. Sorry, the consideration which is paid is lesser than the stamp duty value of the property. So for inadequate consideration means where the consideration is lesser than the SGB. So either I have received the immovable property without paying any consideration, for free of cost I am receiving the immovable property. In that case, if the stamp duty value of the immovable property exceeds rupees 50,000, entire SGB would be taxable. Secondly, for inadequate consideration, where the consideration is lesser than the stamp duty value, then in that case, if the amount of such excess meaning SGB minus the consideration, this excess is more than the higher of the following amounts, is greater than the higher of number 1, 50,000 rupees, %10 of the consideration. So, what it is trying to say is, where I have received the immovable property without any consideration, and if the difference between the SGB and consideration, the excess amount, is greater than rupees 50,000 or 10% of consideration, whatever is higher, then what shall be taxable? Then the excess amount which is there, that will be charged to tax. So the excess amount, which is the difference between the SGB minus consideration, shall be taxable under 56(2)(10). Now again, there arises a complexity as to what you have to take as the SGB rate, or the SGB as on which date you have to take, whether date of agreement or the date of the registration. Yes, Kirti, stamp duty value means the registration value. You're right. So now whether we have to take the stamp duty as on the date, stamp duty value as on the date of agreement, or whether we have to take the stamp duty value as on the date of registration. Yes. So this again we have done as a part of 50C. What did I tell you in the 50C calculation? Yes.
Some date of agreement.
Date of agreement we have to take, but there was one condition for that. What was that condition?
The part of the amount received by via other than cash mode.
Yes. So in a case where, let's say for example, there is a difference between the date of consideration and the date of the agreement and the date of the registration. So in that case, you need to adopt the date based on the condition that whether you have received any consideration by way of the account pay check, account pay draft, or electronic mode. If the answer is yes, then you will take the date of the agreement. But if the answer is no, then you will take the date of the registration. Are we clear? So just write down over here. Same as 50C only. Yeah. Where the date of registration is different from date of agreement. Whether consideration is received on or before the date of agreement by way of account pay check or bank draft or the electronic mode. If the answer is yes, then you will take the date of agreement, SDV, on the date of agreement. If the answer is no, SDV on the date of registration. Yes or no? Are we clear, students, about this? Yes. If the date of agreement is different from date of registration, due to there is a time gap between the date of agreement and the date of registration, then in that particular case, you have to ask a question if you have received any part of the consideration by way of account pay check or account pay bank draft or electronic mode on or before the date of the agreement. So if the answer is yes, then you have to take the date of the agreement. Otherwise, you will take the date of the registration. Are we clear? Yes, any questions so far? Any doubt with respect to the...
Ma'am,
Yes.
ma'am, such income in which hand, income from other sources or capital gains?
This will be income from other sources, right?
Even if capital receipts.
Yes, it's a capital receipt, but specifically charged to tax under 56(2)(10). See, for the recipient, this will be taxed under income from other sources. For the seller, this will be taxed under capital gain. So we are going to do a sum on this particular point specifically. But for the seller, this will be taxable under the head capital gain. For the buyer, this will be taxable under the head income from other sources. When we do the sum, you will be able to understand it in a much more better way. Clear? Any other questions, students? Yes.
Ma'am,
Yes.
buyer is going to purchase, then he has to pay. Then how it is taxable to the buyer?
Okay. See, students, the buyer is receiving the immovable property for inadequate consideration. The buyer is purchasing the property for a less consideration than the SDV. So, well, let's say, for example, the SDV is 1 crore and the buyer is purchasing, let's say, for 90 crores, so 90 lakhs. So, means he is receiving the immovable property for inadequate consideration. And if that be the case, 56(2)(10) gets attractive.
Yes, ma'am.
Are we getting this point? Yes. So it is on the recipient of the immovable property, wherein if you receive the immovable property for lesser than the stamp duty value, in that case, 56(2)(10) will get attracted in a case where the difference between the SDV minus the consideration that you have paid as a result of the transfer, if that is more than 50,000 or 10% of the consideration, 10% of the consideration, whichever is the higher.
Yes, ma'am.
Are we clear? Okay.
It means the entire consideration will be taxable to the seller only for in the head of capital gain, and the excess amount which is the buyer has not given to the HDV, and the consideration difference will be taxable to the buyer only.
See, not entire amount will be taxed in the hands of seller. Seller के हाथ में क्या tax होगा? The FVC will become the stamp duty value.
Yes, ma'am.
Right? He will get the cost of acquisition of the property for sure. While you compute capital gain, you get the cost of acquisition or indexed cost if you have purchased the property before 23rd July. Right?
Yes.
But for the buyer, it will be the differential amount between the SDV minus the consideration that will be taxable for the buyer.
Yes, ma'am.
Clear?
Yeah, clear.
Any other questions, students?
मैम तो फिर जो 10 lakhs है वो दोनों के हाथ में टैक्सेबल हो गया.
Correct.
Okay.
Absolutely. Okay, we will do a sum on this. Don't worry. Once I complete 56 to 10, we will have a break and we will do a full-fledged sum on this particular point, and all of your doubts will get cancelled or will get cleared over here. Okay? Now 56 to 10 C. What does C say? C is any property other than immovable property. So any other property. Again, what do we mean by any property? What kind of property are we referring to? So the property is defined under the Act. Under 56(2) itself, the explanation defines the property. It says property means the following capital asset of the assessee. Immovable property being land or building. So that is any which way is covered here. So any property other than immovable property. Now, what is other than immovable property? Shares and securities, jewelry, archaeological collections, drawings, paintings, sculptures, any work of art or bullion. So, any other property you can write. Shares, securities, jewelry, work of art, right? Now, whether if I receive car more than 50,000, will it be covered under 56 to 10? I am getting car from a friend. Will I be charged to 56 to 10? Yes or no?
Yes, ma'am.
Is it a property? What is property defined? Shares and security, jewelry, archaeological collection, work of art, paintings, sculptures, bullion. Is car a property? Yes? Is car a property?
But ma'am, car is other than immovable property, no?
But other than immovable property, they have defined. What is a property? Property is defined over here. Property means the following capital asset of the assessee. Namely this. Is car a capital asset? Property means the following capital asset of the assessee. Namely, these are just examples. But property is basically capital asset. Is car a capital asset?
Car is classified under personal effects of the
Correct.
assessee.
Absolutely. So car is a personal effect. What is a capital asset, students? Capital asset is defined under which section? Yes, Kirti. Capital asset, car is not a property. Car is a personal effect. Capital asset is defined under 214 of the Income Tax Act. The first day of our class when I started, right? What did I tell you? Capital asset is a property of every kind. It excludes the personal effects. So car is a personal nature. Car is not a capital asset, students. Mark this point. Do not make a mistake. If I receive a car from my friend, I will not be charged to tax under 56 to 10. Neither there will be any capital gain on the sale of car. Car is not a capital asset. It is a personal item. Are we getting this? So now 56 to 10C, what does it say? First, yeah, without consideration. So when I receive, again, without consideration. So receipt of any property without consideration. Where the aggregate fair market value of which exceeds rupees 50,000. So FMV is greater than rupees 50,000. Then the whole of the aggregate FMV shall be taxable. So entire FMV shall be taxable. And if I receive then for inadequate consideration. What do you mean by inadequate consideration? For a consideration which is less than the aggregate FMV. So where my consideration is less than the FMV. In that case, the FMV minus the consideration, it exceeds rupees 50,000. Then the excess amount, which is FMV minus the consideration, is taxable. Are we clear? Yes or no? Any questions, any doubt with respect to the 56 to 10? What do we mean here by FMV? FMV here is defined under Rule 11UA. Rule 11UA gives the different gives the way to calculate the fair market value. Clear? Any questions, any doubt before we move on to the break? Yes or no? Fine?
Yeah.
Okay, so let's stop here for 10 minutes and let's take a quick break and then we get back to this particular topic after that. Let's take a break. Now, before we go towards the sum, let's understand that there are certain exceptions on which 56 to 10 does not become applicable. So what are those cases under which 56 to 10 is not applicable? If you receive any property sum of money from any relative on the occasion of the marriage of the individual, under a will or by way of inheritance. So if you receive any property from a relative on the occasion of the marriage, so that's why you see, many cases where, these gifts are given by these high net worth individuals on the occasion of the marriage of their kids, or maybe, marriage of any other person. They transfer a lot of high value shares of the company. They transfer high value properties to their kids or to different persons, on the, or their relatives on the marriage. So that's the reason, because 56 to 10 does not become applicable at that stage under a will or by way of inheritance. Also, what is the definition of relative over here? So relative is again defined under 56 to under the explanation which is given. What is the meaning of the relative? Relative means, in the case of an individual, the spouse, brother sister of the spouse, brother or sister of either of the parents of the individual, lineal ascendants or descendants of the individual, and lineal ascendants or descendants of the spouse of the individual and spouse of the person, which are referred to in B to F. So the definition of relative is very, very wide under 56(2). Right? Now, what are the other situations in which 56(2) is not applicable? 56 to 10, in contemplation of the death of the payer or the donor from any local authority, from any fund or foundation or university or educational institution or medical institution or hospital or any trust which is registered under 1023C, which is a charitable institutions which are there, charitable trust or educational institutions or medical institutions which are there. Right? Or any trust which are registered under 12A, 12AA or 12AB. Again, the charitable trusts that are registered under 12A, from that, if you receive any gifts or any property or any sum of money more than 50,000, this will not be applicable. Then by any fund or the trust or institution or university, again referred to in 1023C, by way of transaction not regarded as transfer, under clause 1, 4, 5, 6, 6A, 6AA, 6B, 6C, 6CA, what are these clauses of section 47? Do you remember we have discussed 56 to 10 at that point in time? Yes or no? So what are these clauses of 47 where 56 to 10 is not applicable? We have already discussed that. What are these scenarios? Yes.
Ma'am, when the holding company is transfer any and transfer capital asset to the wholly owned subsidiary, then this transfer not considered as transfer under section 47.
Correct. Yes. So 47(1), which is there, is the transfer of or distribution of capital assets on the partition of HUF. Then 47(4) and 47(5), as you rightly mentioned, transfer of a capital asset by a holding company to wholly owned subsidiary, or in a vice versa situation. In those cases also 56 to 10 is not applicable in the hands of the recipient. Then which other scenarios are spoken about here? Yes, let me see who remembers. Which other scenarios? This is one of the scenario which is mentioned. Yes, let me see anyone remembers that.
Ma'am, any transfer of amalgamated
Correct.
company to amalgamating and vice
Correct.
versa.
Correct. So transfer of, not vice versa. In that case, see, amalgamating means there is only one side of it. There is no vice versa. That is only in, transfer of holding company, a capital asset by holding company to subsidiary or subsidiary to holding. There it's a vice versa situation. But in case of amalgamation, there will be only a transfer from the amalgamating company to the amalgamated company. And yes, you are right. When a capital asset is transferred by an amalgamating company to the amalgamated company in the hands of the recipient, which is the amalgamated company, when it receives the capital asset, there will not be any 56(2)(10). Last one more scenario, which was at yes, Mansha, scope of 214 is greater than capital asset, which is referred to in 56(2)(10). But at the end, 56(2)(10) also makes a reference to capital asset. So in that way, the scope of both will remain the same almost. Yes. So you can just write down section 56(2)(10 not applicable. A, receipt from the relatives, right? Once you receive from the relatives, 56(2)(10 will not become applicable. Or sum of any money or property received from the relative. So you can just write here who is a relative. The definition of relative is given here. I'm just putting out the same definition here. Spouse, siblings. I'm writing this for the purpose of you remembering it. Siblings of the spouse. Then brother or sister of the parents. So siblings of parents. Then lineal ascendant or descendant, which are of the individual or of the parents, or spouse of the above, right? And in case of HUF, the relative is, this is for individual. For HUF, the members of HUF are the relatives. Okay, so receipt from relatives on the marriage of individual on or through inheritance or the will from local authority, then from the trust or institutions or hospitals or educational institutions referred under section 1023C. Charitable trust registered under section 12A, 12AA or 12AB. Right? Then distribution of assets on partition of the HUF or amalgamation or demerger or distribution of the capital asset by the holding company to wholly owned subsidiary or vice versa. as referred to in section 47.4 or 47.5. Are we clear, students? Yes or no? Any doubt? Any questions so far? Okay. Yes or no? Any question? Any doubt? So, in these cases, 56.10 is not applicable. Now, there are few more instances that I would like to highlight over here. Basically. Now, in case of this 56.10, right, it is also not applicable where in case of an individual. So where 56.10 is not applicable to any sum of money or any property received by an individual from any person in respect of any expenditure incurred by him on his medical treatment or treatment of member of his family for any illness related to COVID-19. So basically, where the amount is received by an individual for the medical treatment expense for COVID-19, either for himself or his family, in those cases also 56.10 will not be applicable. Are we clear about this? So this is for the medical expenditure if he receives the money either for himself or for the family member. However, the central government has issued a notification that the individual has to keep the record of the COVID-19 positive report of himself or his family member, and he has to submit that detail about the amount which is received. Are we clear? So just write down. Then write receipt by the individual, receipt by the individual in respect of any expenditure on medical treatment for COVID-19 for himself or for his family member. So if he receives the amount, this will not be charged to tax under 56.10. Next one is by a member of the family of deceased person. Earlier one was in respect of the medical expenditure if the amount is received for the medical expenditure of COVID-19 treatment either for himself or his family. Next is by a member of the family of deceased person from the employer of the deceased person or from any other person to the extent such sum does not exceed 10 lakh where the cause of death was the illness related to COVID-19 and the payment is received within 12 months from the date of death. So in case the family member receives it on account of death of person due to COVID-19, in that particular case, that amount, if it is received from the employer, that will not be charged to 56.10. If it is received from any other person, that will not be charged to 56.10, provided the amount is less than 10 lakh. So, receipt by the family member of deceased where death was on account of COVID-19 from the employer of the deceased. There is no limit for that. From any other person where the amount is less than rupees 10 lakh. Are we clear? So in these cases also 56(2)(10) will not become applicable. So in case where it is received from the employer, there is no limit. But if it is received from any other person, there is a limit of rupees 10 lakh, and this amount should be received within 12 months from the date of death. Yes, from the date of death of such person. Okay. Now, one more important point before we just say that, okay, 56(2)(10) is explanation wise, it's entirely done. Now, understand one thing. In the definition of property, the property I have told you, what is the definition of property? It is any capital asset which includes shares, security, jewelry, work of art, or bullion. In that, they have also included if you see, virtual digital asset. So a virtual digital asset is also included. So where you receive a virtual digital asset for inadequate consideration or for without any consideration, you will be charged to tax under 56(2)(10). So remember this particular point. You can write it here. Property includes the virtual digital asset. Are we clear? Any questions, any doubts so far? Yes or no, students? Yes? Any questions, any doubt? Okay, fine. Now we can solve one question. Let me take you to your module, and there is a question there itself. Let me open up the question for you first. Yes. Okay. Are you able to see the screen? Yes? Okay. Mr. Hari, a property dealer, sold a building in the course of his business to his friend Mr. Rajesh, who is a dealer in automobile spare parts, for rupees 90 lakh on 1/1/25, when the stamp duty value was 150 lakh. The agreement was, however, entered into on 1/9/2024, when the stamp duty value was 140 lakh. Mr. Hari had received a down payment of 15 lakh by a cross check from Mr. Rajesh on the date of agreement. Discuss the tax implications in the hands of Mr. Hari and Mr. Rajesh, assuming that Mr. Hari has purchased the building for rupees 75 lakh on 12th July 2023. Would your answer be different if Hari was a share broker instead of property dealer? So yes, what would be the implication first in the hands of Mr. Hari, where he is a property dealer? Yes, students, faster. Income under the head PGBP. Okay. Income under the head PGBP will be there, or income under the head capital gain will be there. For Hari, it will be PGBP. Okay. Let's see. So Hari is a property dealer. So which section you will apply for PGBP over here, students? In the hands of Hari, which section will be applicable? Will 50C be applicable in the hands of Hari? Yes. In the hands of Hari, which section will become applicable? Section 28, Manish?
43 CA.
43 CA. Yes, very good. So 28, of course, will be applicable, but in the hands of Hari, the provisions of 43 CA will substitute the sale consideration with the stamp duty value if the stamp duty value, if the sale consideration is less than the stamp duty value and the stamp duty value exceeds 110% of the sale consideration. Isn't it? Now, Mr. Hari has sold the property for rupees 90 lakh, where the stamp duty value was 150 lakh. So sale consideration is less than stamp duty value. So 43 CA says that you substitute the sale consideration with the stamp duty value if the stamp duty value exceeds 110% of my sale consideration. Now, what is the sale consideration over here? 90. So will I take the SDV as 150 or 140? Which stamp duty value you will take? Yes, students?
150 lakhs should be taken because the Hari received a payment in a crossed check. It is not allowed. As the
Correct.
date of registration, that is 1,50,000 should be taken.
Correct. So, here students, you have to understand that what do we say when you have to take the date of agreement? If the amount is received by way of the account pay check or a cross check, or a bank draft, account pay bank draft or account pay check, or by way of the electronic modes. Yes, Mansha, correct. So in that particular case, you need to take the date of agreement. If you do not receive the amount on or before the date of agreement by any of these modes, then you take the date of registration. So here, if you look at, it says that when the stamp duty value was 150 lakh, whereas the agreement was entered into on 1/9/2024, where the stamp duty value was 140 lakh. So I will not consider 140 lakh because I have received an advance, which is a down payment of 15 lakh, but I have received by a cross check and not by an account pay check. If it would have said in the question that I have received the amount by way of, I have received 15 lakh by way of an account pay check, then I would have considered 140 lakh on the date of agreement. But here I have received the amount by way of a cross check. So that will not be applicable. I cannot then take the date of agreement or the stamp duty value on the date of agreement. I will have to take the stamp duty value as on the date of registration or the date of transfer, which is 150 lakh. Now, whether the stamp duty value is more than 110% of consideration, yes. So therefore, in that case, I will substitute the sale consideration with the 150 lakh. I will not take 90 lakh. My sale consideration will be 150 lakh. So 150 lakh will be the sale consideration. I will get the deduction for the cost under 28. You will get the deduction for the cost. I have purchased the building for 75 lakh. I will not get your indexation because I am in the PGBP. Hari is a property dealer. So I am computing my income under the PGBP. Indexation is not there in the PGBP. Right? So therefore, here I will reduce from the 150, 75 lakh. So 75 lakh will be chargeable to tax as the business income. What if Hari was a broker? Hari was a share broker instead of property dealer. Then which section you would have applied? Yes, if Hari was a property instead of property dealer was a share dealer, then we would have applied which section?
50C.
50C. Correct. And under 50C, what would have been the value? What would be my FVC under 50C? Yes, Mansha. $150 lakh. Yes, Manish. Correct. So again, just like 43CA, 50C again says the same thing. Whether the consideration is received on or before the date of agreement by way of account pay check, answer is no. So I will take the date of registration. Now, whether I have received, whether the sale consideration or whether the SGB, is greater than 110% of sale consideration, yes. So I will substitute the sale consideration with SGB. So my FVC will be 150 lakh, the stamp duty value on the date of registration. From that, will I get the cost of indexation? Yes, will I get an indexed cost? Under capital gain, will I get the indexation on the cost? Yes, Kirti. No, Manish, we will not get indexation because this is a short-term capital gain, not a long-term capital gain. The property was purchased on 12th July 23. So what is my period of holding for the property? What is the period of holding for the property? Yes, how many months do you consider for the property? No, Manish, not 18 months. 24 months is the period of holding that we consider, right? Yes, Mansha. So if the period of holding is less than 24 months, it's a short-term capital gain. So I will not get indexation over here. If it was a long-term capital gain, will I get the indexation in this case? Will I get the indexation in this case? If it was a long-term capital gain, will you get the indexation? Yes, students. I'm not getting answers. Are we clear? Now we are almost done with the chapter or all the heads of income. Will you get the indexation if this was a long-term capital gain, students? Yes, Mansha. Yes, Kirti. No, you will not get. Why you will not get? Because when is the property transferred? The property is transferred on 1/9/24. An indexation option is allowed to a resident individual only in the case where the property is purchased and transferred on or before 23rd July 2024. Isn't it? What did I tell you in the class? Indexation is being done away with after 23rd July 2024. Isn't it? So in case of a land or building which is acquired before 23rd July 2024, there you will get the indexation benefit. Isn't it? So on the asset which is land and building acquired before 23rd July 2024, you will get an indexation benefit, but that is only for the purpose of computing the tax rate and not for the purpose of computing the long-term capital gain. Right? So you will compute the gain without indexation, but when you will calculate the tax, you will have an option to apply 20% with indexation or 12.5% without indexation. But when you will make a computation, in the computation, you will not apply indexation. Right? So for the purpose of calculating the loss, for the purpose of investing the amount in 54, you will not get the indexation. It's only for the calculating the tax, you will get the indexation. Are we clear? But here, since it's a short-term capital asset, there will not be any indexation. So it will be 150 lakh minus 75 lakh, the cost of acquisition. 75 lakh will be the short-term capital gains. Are we clear? Any questions so far? Yes, anyone has any question, any doubt? Everybody clear? If you have any question, if you have not understood any point, please ask me. Now, what will be the tax implication in the hands of Mr. Rajesh? Yes, in the hands of Mr. Rajesh, what will be the tax implication?
Ma'am, 56(2)(x applicable, ma'am.
Correct. So 56(2)(10) will become applicable. Why? Because Mr. Rajesh is receiving the immovable property for inadequate consideration. For inadequate consideration, he is receiving the property. How inadequate consideration? He is receiving the property of he is receiving the property whose stamp duty value is 150 lakh or 140 lakh. Right? For rupees 90 lakh. So the consideration is less than the SDV. Here also we will take the SDV as 150 lakh for the same logic that the amount is not received by the account payee check on or before the date of agreement. So we'll consider the SDV as 150 lakh. Right? So here I am receiving a property worth 150 lakh for rupees 90 lakh. So that is I am receiving for inadequate consideration. I am not paying the adequate consideration for the property. So 56(2)(10) becomes applicable. Now 56(2)(10) is applicable on the difference between the stamp duty value and the consideration paid. So 150 lakh minus 90 lakh, whether it exceeds the higher of 50,000 and 10% of consideration, yes or no? Yes or no? Yes. So 150 lakh minus 90 lakh, which is 60 lakh, exceeds 50,000. And 10% of consideration is how much? 9 lakh. So higher of 2, it exceeds. So 56,210 becomes applicable. So the difference which is there, 150 lakh minus 90 lakhs, 60 lakh will be charged to tax under 56,210. Are we clear about this, students? Is this clear? Yes. Any questions on 56,210? Any doubt? Any questions? All of you are clear? I need the answers in the chat boxes. All of you are clear or not? No doubt? Okay, perfect. Okay, now let's move towards the next topic, which is 56 to 7b. Now, let's write down. Again, it's a very small topic. Just write down 56 to 10b. Sorry, 56 to 7b. Now, what is this particular section about? Let us try and understand, students. Now, this is about the angel tax provision, as we call it. What do we call it? As angel tax. I'll tell you why do we call this as an angel tax provision. Now, this particular section, I'll just give you a brief idea. What used to happen is, the companies used to issue the shares at lesser than the fair market value. Right? So, in those cases, this particular section becomes applicable, which is 56 to 7b. So, where a company, which is a closely held company, a company which is a company in which the public is not substantially interested. I'm just giving you a fair idea because this section is now deleted. I'm just talking about it was applicable in the past. So we are not going to discuss much in detail about this. It's just that I'm going to discuss a little bit because it used to be applicable until last year and now it has been deleted. So in this particular case, what used to happen is that the companies used to issue the shares at lesser than the fair market value. So therefore, there was this angel tax provision getting charged in the hands of the company which are issuing the shares, right, for a consideration which is lesser than the fair market value of shares. But now this provision has been omitted from by the Finance Act 2024. So you can just write down, this is now omitted by Finance Act 2024. You can write the meaning of this particular section for you to just know that there was some kind of section which was applicable until the last year, where closely held company receives the consideration for issue of shares greater than the fair market value. Where closely held company issues the shares for the consideration greater than the fair market value. Right? So in these cases, the issue price minus the FMV was taxable under the 56 to 7b. So issue price minus the FMV, because they used to issue at a premium, right? So therefore, this particular section was applicable in the hands of the closely held company. Now this has been omitted. So this is not applicable from your attempt onwards because this is omitted by Finance Act 24. So this is just for knowledge purpose. I told you that this was some section which was applicable, but this is not applicable now to your attempt because this is omitted by Finance Act 24. The last topic that we are to discuss with. Taxation of the life insurance policies. And then there will be last a very, very small topic in respect of the units of the business trust. But first we'll spend now the remaining time on the amount received under LIP, which is the life insurance policy. Now, the sum received under the life insurance policy. If the life insurance policy is issued prior to 1/4/2023, if the life insurance policy, or you can just write here, taxation of amount received under the life insurance policy. So if the life insurance policy is issued prior to 1/4/2023, right? So in that particular case, the amount which used to be there, used to be exempt in the satisfaction of one condition. Now, what was that condition? One second. Let me just make a chart little bit more elaborate. Yes. So what used to be the condition? The condition was that the amount of premium should be less than the 10% or 15% of the sum assured. Isn't it? So if the LIC, if you used to take, in the IPCC also, you would have seen that you used to compare what is the sum assured and what is the premium being paid. Isn't it? So where the amount of premium was less than 10% of the sum assured, in those cases, the amount which is received on the LIC used to be the exempt amount under section 10(10)(d). Isn't it? Do you remember this particular provision you have studied during your IPCC also? So if my life insurance policy was prior to 1/4/2023, I used to have the exemption of the amount under 10(10)(d) if the premium was lesser than 10% of the actual sum assured, or 15% in case of the disabled person, right? Or suffering from specified diseases. So what used to be condition? Exempt under section 10(10)(d) if premium less than 10% or 15% for disabled of the sum assured. Now, in case of the amount received after 1/4/23, they have put an additional condition on us. Now, what is this additional condition? The additional condition is that any sum received under the LIP will be exempt if two conditions are satisfied. Number one, if the premium payable does not exceed 10 or 15% of the sum assured, and the premium does not exceed 5 lakh rupees for any of the previous years or for the aggregate of the policies that I have taken. So, what are the conditions? This will be exempt under section 1010D if premium is less than 10% or 15% of my sum assured, and the premium does not exceed rupees 5 lakh. And the premium on all the policies taken together does not exceed rupees 5 lakh. So you can write aggregate premium does not exceed rupees 5 lakh. So now I have an additional condition of rupees 5 lakh becoming applicable to me. If I violate this condition, then the income will be now chargeable under the head income from other sources under section 56 to 13. Now, income will be chargeable under the head income from other sources, specifically under section 56 to 13. So, if you remember that day, yesterday, we had done this particular point. I have written here, if you see this, sum received under the LIC. Right? So, 56 to 13 says, if conditions are not satisfied, then taxable under section 56 to 30. What is the amount taxable? A minus B. What is A minus B that they are saying? So A minus B will be nothing but the amount received minus the premium paid for it. Minus the premium paid for it, that will be the amount which will be exempt under, which will be chargeable under 56 to 30. Are we getting this particular point? So just write down. The taxable amount will be C. Let me open up 56 for you. Where any sum is received under a life insurance policy other than the sum received under ULIP, being the income referred to in under section referred to in clause 4, which is not to be excluded from the total income of the previous year in accordance with 1010D, the sum so received as exceeds the aggregate of the premium paid and not claimed as deduction under any provisions of this act, computed in such manner as may be prescribed. So basically, what they are trying to say is that here, what will be my amount which will be taxable amount is nothing but the sum received minus the premium paid. Are we clear? So just write down. Are we clear? Yes, Jenny. I was going to ask this particular question itself. Now, which is the provision that you think you have already learned so far with respect to the similar thing I have already discussed? So I've already discussed this particular thing in another provision that you would have learned. Which is that provision? Ginny, you have rightly pointed out. Others, can you remember? We have already discussed this kind of provision. Mansha, the provision says it will not apply on or after 1/4/25, which is 5627B you are talking about. It means the assessment year 1/4/25. So financial year 1/4/24. When it says it will not apply on or after 1/4/25, it is referring to the assessment year and not the financial year. Yes, which is the similar provision that you have already studied so far, students? Yes, who remembers? Yeah, Kirti, it is the policy issued and not the sum received. You're right. So this should be policy issued prior, not sum received. My mistake here. Policy issued prior and the policy issued after 1/4. Not the sum received. Yes, Kirti, you are right. Yes, students, which other provision you are not able to recollect? 45(1)(b). Yes, for the ULIPs. ULIP is now regarded as a capital asset. Now you recollect, students. 45(1)(b), capital gain. Under capital gain, I had told you ULIPs are now regarded as a capital asset if the ULIPs are not exempt under 1010D. Which ULIPs are not exempt under 1010D? Yes, Pastor. Which kind of ULIPs? Yes. Which ULIPs are not exempt under 1010D? Yes, students. Faster. Where the premium paid is more than? Where the premium paid is more than? Yes. 2.5 lakh. Yes, Mansha. So where the premium paid is more than 2.5 lakh, those ULIPs are regarded as the capital asset. And also the premium exceeds 10% or 15% of the sum assured. Isn't it? So, in the cases where the sum assured which is there, of which the premium exceeds the 10% or 15%, and where you have the premium exceeding the 2.5 lakh, those ULIPs are regarded as capital asset under section students 214. Isn't it? And therefore, when you sell that when you receive the amount on that, that will be taxable under the head capital gain. Are we clear? Yes or no? That is taxable under the head capital gain under 45(1)(b). What was 45(1)(b)? 45(1)(b) was the A minus B, which is the amount received minus the premium paid till the date of receipt of amount. Isn't it? So therefore, in that situation, for the ULIPs, it was regarded as capital asset because these were units, right? Whereas for the life insurance policy, other than ULIPs, the income is taxable under the income from other sources. So, sum received under LIP other than the ULIPs. Other than the ULIPs. If it is with respect to the ULIPs, if it is with respect to the sum received under ULIPs, then you have to go to the capital. Are we clear? Yes or no? So you can just write it over here. Sum received under ULIP. If the premium exceeds 10% or 15% of the sum assured plus premium greater than rupees 2.5 lakh, right? Then in that case, this is regarded as capital asset under section 214 and capital gain is under 45(1)(b), which is A minus B, which is sum received minus again premium. And if these conditions are satisfied, then in that case, this is exempt under section 1010. Clear? Then what about the sum received under the Keyman insurance policy? Sum received under the Keyman insurance policy is taxable, isn't it? We discussed yesterday only. Sum received under the Keyman insurance policy is taxable if it is received by employee, then under section 17(3), if it is received by the businessman, then under section 28, and if it is by the others or family members, basically, then under 56. Right? That day only we discussed about the Keyman insurance policy, if you remember here. Sum received under Keyman insurance policy. Right? So under 56(2), it is taxable if it is received by the family member. Right? Are we clear about this? In case the sum is received on the death of the person, if the sum is received on the death of the person, then in that particular case, irrespective of any limits on the premium, the amount will become exempt. If the sum is received on the death of the person, then irrespective of the amount of premium paid, the amount will be exempt under 1010. So just write now. Just write it over here. Sum received on the death of the person. One second. Yeah. And right here. Sum received on death of the person is exempt under section 1010D irrespective of the limit on the premium. Right? If a person dies, then the limits will not be mattered. Are we clear? So in that case, the entire amount will become exempt. Further, any sum received under a term insurance policy shall also be continued to be exempt under 1010D irrespective of the amount of premium paid. And further, the premium of term insurance policy will not be considered for calculating the 5 lakh limit. So, sum received on the term insurance policy, again this is exempt under section 1010D irrespective of the premium paid. Also, premium on the term insurance policy will not be considered for calculating limit of rupees 5. Are we clear? So for term insurance policies, we will not consider the limit of the 5 lakh rupees. Term insurance is basically for a particular period that the insurance is taken. Life insurance is for the entire life. Are we clear? Yes or no? Any question, any doubt? So term insurance is for a specific period that will be covered under 1010D still without any amount of limit which is there applicable for the LIPs. Yes, any questions, any doubts so far? Okay, fine. Now let us discuss few examples on this particular point. Let us discuss few case studies on this point, which are both applicable for the ULIP or for that matter, the LIP as well. Clear? For the LIP, you have to see the date of 1/4/2023. For the ULIP, you have to see the 1/2/2021. Now, let us consider here few examples that I am going to take up with you. Fine. Number one example. Let's say the premium paid which is there. Right? Let's say my premium paid is 5 lakh rupees and sum assured is, let's say, 50 lakh. Sorry. Let's say my premium paid is 5 lakh. Sum assured is 50 lakh. Let's say the consideration received is 52 lakh. Now let's say the policy which was there was taken on 1/4/2023. let's say policy taken was the, let's say, LIP on 1/4 or before 1/4/2023. You can write. What will happen to this amount? Yes. This will be exempt or this will be taxable? Yes, students, this will be exempt or this will be taxable?
Ma'am, this will be taxable as it is not less than, it is equal to the sum 10% of the sum assured.
See, here it will, first of all, we will not consider anything over here. Because if you look at this particular example, which I have talked about, here date of issue of the policy is prior to 1/4/2023. Right? Now, in that case, the only condition that you had to check is whether the premium exceeds 10% of the sum assured. Whether the premium exceeds the 10% of sum assured. Yes.
No.
No. So in that case, there is no question of it being taxable. See, as I said to you, you have to test this condition when the policy is issued after 1/4/23. The 5 lakh condition is to be tested when the policy is issued after 1/4/23. Since here the policy is issued prior to 1/4/23, you have to check whether the insurance premium is
Ma'am, I have
greater
checked
than,
that.
sorry,
एक्चुअली मैंने वही चेक किया था प्रायर 1/4/2000. एक्चुअली नोट्स में क्या लिखा हुआ था कि लेस देन 10%, नॉट
yes,
इक्वल, लेस देन इक्वल्स टू, ऐसा कुछ नहीं लिखा हुआ था, इसीलिए मैंने वो कंसीडर किया.
okay, understood. So here, whether the insurance premium is more than 10% of the sum assured, answer is no. It is not exceeding. So therefore, in that particular case, this is exempt under section 10. Are we getting this particular point? So you need to check whether the policy is exceeding. It says it should exceed 10% of the sum assured. If it does not exceed 10% of sum assured, the matter gets over there. This will be exempt. Clear? Now, let me take one or two more examples. In this case, let's say, for example, now I have taken, let's say, two policies. Both are issued after 1/4/2023. And let's say the premium which is paid is, let's say, now I am making two policies, A and B, and I am writing the date of issue 1/4/2023. And let's say the premium paid. For A, the premium paid is amounting to rupees 4.5 lakh. And for B, let's say the premium is 5.5 lakh. My sum assured is, let's say, 45 lakh and 55 lakh. Now, consideration received which is there. Let's say this amounts to rupees 52 lakh and 60 lakh. Now, whether this will be exempt or this will be taxable. What about the first policy, policy A? What about the policy A? Yes, in the policy A, will this be exempt? Yes. Yes, Manish, right? Term insurance, Kirti, is not the general insurance. Term insurance is for a particular period of life. Policy of A, Mansha, will be exempt. Yes. So, if you see, when you have two policy students, right, as compared to one, it says you have to take the aggregate of the premium. You have to see whether the aggregate of the premium payable on the policies does not exceed 5 lakh for any of the previous years. And the annual premium should be less than 10% of the sum assured. Now, here we need to look at the two premiums that are paid together. In this case, the aggregate of the annual premium, which is there, exceeds 5 lakh. The aggregate of the annual premium for A and B combined, this is to be checked and not individual premium. So I have to see whether the aggregate premium, this exceeds rupees 5 lakh. Isn't it? So both the conditions need to be satisfied in order to claim the exemption. Even if I fail one of the condition, this amount will not be exempt. Right? It's not that if you do not satisfy both the conditions, only then you will not be taxed. It's not like that. Even if you fail one of the condition, it will be taxed. So here the aggregate premium exceeds rupees 5 lakh. But the CBDT circular gives you an option. What option it gives? It says if the consideration received under one of the policy does not exceed 5 lakh and also the premium does not exceed 10% of the sum assured, then that one policy can be claimed as exempt. So this, since the premium here is less than rupees 5 lakh plus less than 10% of the sum assured, this can be claimed exempt and this shall be so. Are we clear? So CBDT circular says that if I have one policy whose premium is less than 5 lakh and it's the sum less than 10% of sum assured, then in that particular case, it will be exempt. Clear? Are we clear? Yes or no? Okay. X, A, B, and C.
Excuse me, ma'am.
Yes.
Ma'am, can you explain this premium exceed the aggregate premium? You have told 4.5 lakh and 5.5 lakh we consider aggregate premium.
Yes.
Then you have written here it is exempt and here it is taxable. This individually we consider.
Yeah. So CBDT circular says that you have to consider the aggregate premium, but then it says that if one of the policies premium is less than 5 lakh, then you can claim that particular policy as only exempt.
Okay, okay, ma'am.
Yeah. Okay. Now, let's say for example, my date of issue is 1/4/2023. 1,424, 1,424, and 1,4, let's say 20. Let's say my premium amount is 4.5 lakh, 1 lakh, 1.5 lakh, and 6 lakh. Clear? And let's say my sum assured is, I'm writing essay, 45 lakh, 10 lakh, 15 lakh, and 60 lakh. Let's say consideration received on 1/11/33 is 50 lakh, and on 1/11/34, previous year 34 I'm talking about, is let's say 12 lakh, 18 lakh, and 70. Now here, the consideration for the first X, if you see.
Excuse me, ma'am.
Yes.
You have written 33 and 34. It should
It's
be
previous year 33-34.
23 नहीं होना चाहिए.
नहीं, 23 नहीं. ये 10 साल के बाद पॉलिसी रिसीव हुआ है.
Okay.
Yeah. So let's say in the previous year 33-34. These are examples given by CBDG circular only. So we have taken as this example. In your module also you will find them. Now if you see for the policy X, the premium is less than 5 lakh. Right? Now these policies are issued in 2 different years if you see. So for the policy 1X, if I look it individually in the year, because this will be in the year 33-34 I'm talking about, right? I'll be first examining from the previous year 33-34 perspective. So policy X ka premium is less than 5 lakh and the premium is less than 10% of the sum assured, right? So in that particular case, I can exempt the policy X. So this will be exempt. Here I am not aggregating because here I am only looking at this year for that matter. However, if you look at A, B, C, their total premium is exceeding 5 lakh, right? Their aggregate premium is greater than rupees 5 lakh. Now, if you see the aggregate premium, once it exceeds 5 lakh, then in that particular case, this will not be considered as exempt. And here if you see, it was not exceeding 10% of the sum assured, so that's fine. But the aggregate premium was exceeding 5 lakh. And you've already claimed one policy as exempt, which is X. Now, if you combine all X and A also, if you see, this was also exceeding 5 lakh. Since you have already claimed X as exempt, now you will not be able to claim A, B, and C as exempt. Are you getting this particular point? Yes or no? So in case I have already claimed this amount as exempt, I will not be able to claim it again any other policy in the next year, even though it moves to the next year. So when my aggregate premium, I will see for all of the years together. And then I will decide as to which policy I have to claim exempt. Now, till the time, let's say for example, here I have 4.5 lakh. I have already claimed this exempt. That is fine because this was less than 5 lakh. But when I see this 4.5 plus 1 lakh, can I claim A also as exempt? No. because their aggregate premium exceeds 5 lakh. As aggregate with A with X exceeds rupees 5 lakh. Similarly with B and similarly with C. But let me tweak this example a little bit. And then you will understand more. So, let's say for example, in the next example, I again take X, A, B and C. Here I keep the date of issue as 1/4/23, 1/4/24 and 1/4/24 and 1/4/24. Let's say my premium is now I'm keeping 2 lakh, so 2.5 lakh, 2 lakh, 2.5 lakh and 6 lakh. Let's say my sum assured is 25, 20, 25 and 60. And let's say consideration received on 1/11/33 is 30 lakh, and in 1/11/34 I received 24 lakh, 38 lakh and then 70 lakh. Now in this case also I will claim excess exempt as premium less than 5 lakh plus 10% of the sum assured, right? In the next year, the aggregate premium again goes up to 5 lakh. But here CBDT says that if I want, I can take any of the one policy A and B as exempt. Out of A or B, I can claim as exempt. See, in the last example, I had only 4.5 lakh, which I had exempted. अभी मेरे पास कितना लिमिट बच गया था? Out of 5 lakh, balance was only 50,000 limit, which was left. All these policies were more than 50,000, so I couldn't claim A, B, and C as exempt. But here, I have claimed only 2.5 as exempt. So I still have a limit of 2.5 lakh left. So if I want, I can claim either A or B as exempt, because I still have a limit of 2.5 lakh out of this 5 lakh. In the earlier example, out of 5 lakh, the balance was only 50,000. So as aggregate with X was more than 50 lakh, I couldn't claim A, B, C exempt. But here I can claim either A or B as exempt. So whosoever consideration is more, the amount received is more, I will claim that policy as exempt. I cannot claim C as exempt for sure. But I can claim B as exempt as what will happen? The consideration here received is higher. So I will end up paying higher taxes if I claim A as exempt. So I will claim B as exempt as consideration is greater than A. So it will be beneficial. Is this clear to all of you? Is this well understood? Yes or no? All of you, are you clear about this point? So what is happening is you can claim a policy as exempt out of the bunch of policies you have when the aggregate premium is more than 5 lakh, but the premium of that policy should be less than 4.5 lakh. Clear? So you can claim multiple policies also exempt, but the total premium of your exempt policies should be less than 5 lakh. Clear, all of you? Yes? Perfect. Now, this same examples will even apply in the case of the ULIPs. See, these examples that the CBDT has given us, these are not only applicable for the LIPs, these are even applicable for the ULIPs. Are we getting? But for ULIP, you will consider the limit of 2.5 lakh instead of the 5 lakh. In the case of ULIPs, you will do the same comparison, but you will claim 2.5 lakh as exemption. So all these examples are equally applicable to ULIPs. Exemption limit for ULIPs is 2.5 lakh. So instead of your 5 lakh in ULIPs, you will consider 2.5. Are we clear? Yes or no? Any questions? Any doubts? Okay. Now the last particular point that I wanted to discuss was with respect to the units of the business trust. Now there's a small point. See, again, you will learn this particular point when you will do the assessment of various entities class. At that point in time also you will learn. Now, in respect of the units of the business trust, the amount which is received by the unit holders, right? The amount which is received by the unit holder. Let me open up the act for you so that you can just directly see from there. Yeah. So if you see any sum received by the unit holder from a business trust during the previous year with respect to the unit held by him at any time during the previous year will be taxable under 56(2)(12). What is the amount? Amount is A minus B minus C. Now, A is the aggregate of the sum distributed by business trust with respect to such unit other than which is in the nature of 1023 FC or FCA of section 10, which is the rental income or the interest income or the income not chargeable to under 115 UA. And B is the amount at which such unit was issued, which is the cost of unit, and C is the amount charged to tax in the earlier previous year. So basically, what it is trying to say is that any amount which is received by unit holder, which is basically repayment of capital, is going to be taxed under 56(2)(12). Now, this again you will be learning in the assessment of various entities class. So that time it will be much more clearer. So that's the reason why I'm not going in depth at this point, because this has to be linked with the assessment of various entities or the assessment of trust, where we will be discussing about the business trust taxation. So that is something that will be taken care there. Now, rest of it is again, I'm taking up from the module. So basically, we are talking about the section 57 and section 58, which is the deductions and disallowances. So in deductions, again, in the case of dividends, we have already discussed that you will get the 20% of the interest expenditure, which is there. In case of interest on securities, you can claim the commission, remuneration, all of that. Then, in respect of the employee's contribution, which is received to the provident fund, you can claim that amount deposited to the fund on or before the due date. That amount you can claim as exempt, right? So we have already seen the main important point that you have to remember with respect to the two things is basically this particular point, which is the dividend. So as I said that with respect to the dividend, you have to remember that you have the dividend deduction under section 57, which is the interest amount which you have to consider, right? So interest which is only up to the 20% of the dividend income is something that you will allow here, not anything else. So sorry, this commission should not be there. Interest expenditure up to the 20% of dividend income is allowed against the dividend income under section 57, right? Then with respect to the letting of plant and machinery on hire or the furniture, You can pay the amount of repairs, amount of insurance, and the depreciation on that as the expenditure you can claim. In case of family pension, you will get deduction of 15,000 or 25,000 in the default regime, 15,000 in the case of optional regime, whichever is less, which is basically 1/3 of the family pension amount. You can claim the exemption, right? You cannot claim any expenditure which is in the nature of capital expenditure. So basically, you can claim any other expenditure which is in the nature of for the earning the income, just like our section 37. Enhanced compensation, we have already seen, you get 50% of that. Then you have certain disallowances, just like section 37. Personal expenses will be disallowed, capital expenses will be disallowed. Any interest chargeable to tax on which TDS is not deducted if it is payable outside India. Any salaries on which TDS is not deducted if it is payable outside India. So just like your business income. Any cash expenditure more than 10,000. Then in case TDS has not been deducted and paid before the due date of filing return of income, 30% of the expenditure will get disallowed even under the income from other sources. No expenditure against the casual income, right? So with this, your income from other sources gets over, and with this, all your heads of income also are over. If you have any question, you can please ask me. Otherwise, we can just stop over here and your next sessions will then start. Thank you so much, Ginny. I am glad that you liked the lectures. Thank you so much. Please provide your feedback. That is very, very important for us. If you have any questions, please send out that as well. We'll be surely answering all of your questions and queries that you have. Thank you, Keerti. So thank you so much, students. Please revise my humble request to all of you, and so that you will be able to then remember all the provisions. The head of income are very, very, very important for you. So please keep revising those, because otherwise you will tend to forget. More than revising, you also need to practice, students, because the more you will practice these examples, the more you will be able to solve these questions, right? So clear your basic concepts as much as possible. Okay. So thank you so much and all the best. Okay. Yes. Good night.